Hello traders, Gary Wagner here. Just about 12:45 in Honolulu, 5:45 in New York. It is Tuesday, Election Day, November the 3rd, 2020, and this is the Daily Report for gold and silver. As we are in Hawaii, some of the polls are already beginning to close. Counts will be tabulated, and there will be some sort of an announcement forthcoming, probably over the next 24 hours. I'm not going to venture to say who. However, I do believe that there is a big change in the air. That being said, we did an interview yesterday with David Lynn in which we talked about different strategies, of course, depending on the outcome. And we sent out a special trade alert last night so that those could enter positions as they woke up and entered into the New York markets. Gold is trading roughly at 1910. We got in roughly at 1899. We'll talk about those trades afterwards, but first, please enjoy the interview with Kitco News and David Lynn.
Equities markets are rebounding Monday following last week's losses. As of 3:50 p.m. Eastern Time, the S&P 500 is up 1%. The Dow Jones is up 1.5%. The Nasdaq is flat. Gold is also up. Joining me today to talk about prices and his expectations going into the election is Gary Wagner, editor of thegoldforecast.com. Gary, it's so good to talk to you the day before the election. What are you looking forward to? What are the scenarios you've planned out in your head and your analysis that are going to move prices, Gary?
Well, there are really two possibilities, whether it's a Democratic win or a Republican win. Let's first look at the scenario. If Trump wins, because he is a Republican, he still will need to pass fiscal stimulus in terms of an aid package. He has agreed to $1.8 trillion, while the House has been fighting for $2.2 trillion. Although they're not that far apart, I would expect them to both dig in fairly deeply. On the other hand, if we see a Democrat win the presidential election, I think that fiscal spending will be much larger because the reforms of the Democrats seem to favor big government spending. I think in either case, we will see gold rise if there's a stimulus bill package. And my belief, it's not if, but when.
Okay. What about the equities then immediately after the election? Are you expecting a calm like today, or are you expecting more of a more volatile time?
Well, that's a hard question to answer. Once again, I think it depends on who wins in terms of the presidential election. Up till now, Trump has been exceptional for U.S. equities. There have been talks of fears if it's a Democrat that comes into office, it could be very bad for stocks. More importantly, if he raises taxes, especially on capital gains, we could see some downside pressure.
So Gary, since we're still talking about prices, let's talk about the inverse relationship between gold and the U.S. equities. Now, I know you've talked about this in the past, but what I've noticed in the last couple of trading sessions, including today, is that gold and equities have moved in tandem. So today, the S&P 500 is up. Gold is also up. Last week, Monday and Wednesday, we had sell-offs in stocks. Gold also sold off then. Where do you see this relationship headed? Can we see a decoupling continue?
Well, the first thing is it's not as clear-cut as many people believe it to be. We'll put up a chart right now which has the gold futures on the top and the Standard & Poor's on the bottom. And I've drawn different areas in there. If you've got that up, you'll see that the first two small boxes to the left occur in approximately 2009. That is when we had the banking crisis, and it's also the beginning of quantitative easing. Both gold and equities take off like a banshee. They go to record highs in some cases, in the case of gold. But what is interesting is about middle of 2011, quantitative easing winded down. We went into twist 3 and then wound it down by 2014. Equities kept on rising, but gold began to fall. So we've seen scenarios in which they moved to the same direction in tandem. We see scenarios in which they're actually moving in opposite forces. And we've seen some action recently where we've seen gold really move sideways and U.S. equities move up. Recently, equities have been a lot more wild than gold. We saw a big dip a little while ago, and we've seen gold flat, but now is moving up quite nicely. To answer your question directly, depending on the scenario, will determine what kind of relationship there is between those two asset groups. Because as you know, traditionally, risk on and safe haven always work in an opposite direction. But when you look at the historical data, that is not always the case.
Okay. When they've broken their inverse correlation, what were some of the common factors behind that breakup? Is that, do we have periods of inflation? Do we have excessive quantitative easing? Do we have a lot of fear in the markets and everybody just sold off and raised cash? What were some of the common denominators?
Well, we've got to talk about two different types of sell-offs and moves. First of all, when you see equities move up, gold move up, but then equities come down, typically what you're seeing is the end of quantitative easing. And as quantitative easing ends, people get out of the gold market because that's stopping the creation or printing of money. However, businesses are able to utilize the money they've already borrowed, and more importantly, the inexpensive interest rates to do M&As and other things. And that's why you'll see it continue to go higher, but see gold reverse.
Okay, let's talk about the economy now. Last week, GDP, third quarter GDP came out. Real annualized GDP, according to the BEA, was released, 33% growth in the third quarter. That is a huge number on an annualized basis. So my question to you, Gary, is are we out of a recession? Because look, it's been a while since I was in economics class, but I distinctly remember that the definition of a recession is 2 consecutive quarters of negative GDP growth, and now we're having a huge positive quarter. So what do you think?
Well, the definite answer to that is yes, we are having a recession. The St. Louis Fed and the Economic Bureau put out information showing that last quarter we had a decline of 31%. This quarter we had an increase, I believe, of 33%, but it is compared to the prior month. So when you have such a down month as we did, or a down quarter, as we did last quarter, it doesn't take a lot to go 3 points above that. And so the key takeaway is when you have the worst economic growth on record, so to speak, it's very easy to outdo that the following quarter.
Yeah, and it's important to note also that a 33% climb from a 33% drop still means that we're below pre-COVID levels in terms of GDP output. So clearly we're not fully recovered beyond, we're past our pre-COVID levels, but are we still in an environment where growth can be sluggish, where we have a lot of just drag on the economy, Gary?
Well, the way that the Fed analyzes whether or not we're in a recession is they look at 4 primary points. The first point that they look at is the unemployment record, how many people are employed. Second thing is business productivity, consumer durable goods, and then those collectively are what they use to analyze whether or not the economic growth is on par with anticipation or if it is below that. Right now, even though our unemployment rate has gone to 7.9, that still amounts to over 12.6 million individuals out of work. And that's a lot of people that are not working. Yes, they're getting government assistance, but more importantly, they're not thriving.
Yeah, so things are getting better, but it's still not great is what you're saying. All right, let's look at this chart itself. It's showing the growth level here. Can you break down GDP for us? What component of GDP was driving up this growth this quarter?
Well, when you look at it, as I said, there's 4 basic things that are really, really important. If you've got that up, it is business investment, government spending. It is also net exports and personal consumption. Personal consumption has to be down from what it was. People still have to eat and they're spending money, but they don't have the disposable income. I can't talk about our exports because I don't have knowledge about that, but companies have been very productive, and that's very, very important. And then lastly is government spending. When you allocate $3 trillion on an aid package, that's government spending to the 10th degree. And that is the biggest problem we're facing now.
I guess economists could argue whether or not that aid package has been allocated productively is I guess the big question, because just because GDP is up, because government spending has grown, it doesn't necessarily mean that the economy is really recovering on the right path.
That's absolutely correct. And one of the things you want to look at is the differential between fiscal spending and monetary policy. The Fed does monetary policy. And even though we're printing money, so to speak, adding to the liquidity pool, those are still assets that they have and they can sell at some point. It's not lost forever. However, when the Treasury Department allocates $3 trillion for the PPP program, as well as additional money to unemployed Americans, that's spending and that's money we will not get back. And that's where you have this huge, huge growth in our national budget deficit. I believe we took in $6 trillion and we spent $3 trillion. And that's where we get such a big budget deficit this year.
Okay, let's take a look at the technicals now, Gary. Starting with gold, where do you see short-term movement headed?
In terms of the moves itself, we have different levels of support and resistance. First of all, it did break through $1,900 per ounce, and that to me is huge. And then when we look at it, we have to look at where the 50 and 100-day moving averages are, because the high today was just at that 100-day moving average. That is where I'm seeing pretty strong resistance, of course, 1920 above 1900, and support at 1865 to 1875.
Okay. And the U.S. dollar now, Gary?
The dollar has been interesting. And I say that because typically it does not act as a safe haven asset. You get moves into gold and you get an inverse reaction between the dollar and gold. However, what's been happening is when US equities sell off, that money goes into dollars and it's actually acting as a safe haven asset.
Yeah, okay. I guess treasuries have the same story as a dollar then, isn't it?
Right.
Okay. Now, Gary, last question. It's the day before the election. Are you putting on any new trades or are you waiting for the results to come in?
That's a good question. I would like to position ourselves on the long side because I believe regardless of who wins, when a fiscal stimulus package is actually enacted, we will see gold take off. However, I'm a little bit hesitant in case we get the opposite effect, a prolonged period where there's no fiscal stimulus, say till after January, and then we could see gold under pressure. So there's no clear-cut path unless certain things happen. And that's where I stand.
Okay. Well, I guess the clear-cut thing that we've discussed is that the economy is still weak. So under these circumstances, you'd still expect gold to perform well, right? If you assume it's a hedge against equities, I mean, is it possible then that it could still sell off with risk assets?
Well, we saw that happen the other day. What tends to happen is when you have deep declines in U.S. equities, they liquidate gold, whether it's for margin calls or just to get more into cash. We have seen that happen very, very recently. But for the most part, when equities are weak, it tends to move money into gold, which is the safe haven asset. Just recently, we've not seen that correlation as tight as we have, say, 6 months ago.
Okay. I know I said final question, but now I have more questions for you regarding the technicals because you just brought up some really good points. Going back to your gold futures chart, if you look at some of the moving average lines, what trends are they pointing to? Is it more upward motions, or are we seeing a bear trend right now? What is it showing?
Right now, we absolutely have a bias to the bearish side. The reason I say that, current pricing and the close today is below the 100-day. 100 is typically an intermediate size average when we determine trend. The 50-day moving average determines short-term trend, and we broke through that a while ago. We're nowhere near the 200. So based on the moving averages alone, we have to say we have a bearish slant to a gold market right now.
Okay. Well, would you wait for the pullbacks then to add to your position?
I think that the market is based on and waiting for fundamental headlines. That's what's driving it. We could see it under enormous pressure. A headline hits and we get a 180-degree reversal. I don't think anything that is that simple to predict when we have such a complicated scenario right now.
Well, okay. So is there a floor that you're confident that it would not breach?
In terms of gold pricing, it has to be 1865. That represents the 38% Fibonacci retracement. It's a long data set from 1450 to 2088. So I think that should definitively hold. We've seen it go close to it, but never break below it. Not recently.
Okay. So Gary, let's say the gold price breaks below 1865. Would you then initiate a sell order, or would you buy on the dip?
Well, if it closes below that price point and we see follow through the next day, we could easily see it move to the low 1800s as low as 1765. That would be the next ultimate level of price support.
Gary Wegner, thanks very much for coming on the show today. Happy trading and good luck.
Happy trading to all, and thanks so much for having me. I hope you enjoyed the interview with myself and David Lin. And my recommendation is to maintain your current long positions in gold futures, silver futures, and gold forex, as well as the ETFs, SLV, and GLD. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.